What's the role of leverage and asset prices for macroeconomic outcomes? To answer this question, we discussed with Moritz Schularick, professor of economics and economic history at the University of Bonn and researcher at the CPR in London and the SEFO Research Network. This podcast was recorded on the 20th of March 2019 in the occasion of the executive training course entitled Credit and the Macroeconomy, Leverage Cycles, Asset Prices and Crises, organized by the Florence School of Banking and Finance at the European University Institute in Florence.
Professor Schularick, thank you very much for your availability and for having taught this course on credit and macroeconomy in Florence these days. You opened the course with a historical overview of the evolution of housing finance, which has recently come to play a central role in modern macroeconomy. In particular, you introduced the concept of great mortgaging. Could you explain what it entails and what are the lessons that we can learn when assessing business cycles?
Yes, and thanks for having me. The concept of great mortgaging refers to the historical evolution of credit, and especially mortgage credit, in advanced economies in the last century. And what we've seen here is a large expansion of mortgage credit relative to income, but also relative to the value of houses and land in the economy. The implication is that we now have much larger financial sectors that have, especially banks, whose assets are very strongly concentrated in the real estate sector, and especially in terms of lending to households that buy houses with the funds. Now, that has various implications for financial stability, but also for the business of banking. With regard to financial stability, the main feature really is that our modern financial systems are very vulnerable and sensitive to fluctuations in the price of houses and the price of real estate. And that is price risk that is very hard to diversify from the perspective of the individual banks. So we are in a situation where effectively we have very large financial systems that are exposed to what could be called a market risk or systematic risk that is very difficult to diversify.
Indeed, and focusing especially on this risk part, with reference to financial instability, you discussed today the causes and effects of financial crisis. So focusing on the crisis prediction models, how do you think that different economic indicators perform?
There are two views about what ultimately drives the risk of financial instability in modern economies. And the first view is that it has to do with incentive and agency problems in the financial sector. So in that view, bank managers, CEOs, bankers, generally speaking, have an incentive to take on excessive risks, and these excessive risks then lead to financial instability because they're excessive, because they operate in an environment where they do not fully internalize, when they're not responsible for the losses that potentially result from what they're doing. This is often referred to as a so-called skin in the game view. If bankers had more skin in the game, they would be more prudent and these things wouldn't happen. There's another view, which is an older view, which has to do, which people like Hyman Minsky and Charles Kindleberger adhere to, which has more of a behavioral flavor, which says, like, while there might be an agency and incentive problem sometimes at work, the evidence that we have points to the fact that there's over-optimism periodically, like a behavioral component that you see across markets. So one striking feature, for example, of credit booms, these periods of risk-taking by banks, periods of elevated rates of lending, is that the stock market also does not seem to think that what is going on is more risky than usual. So that would be evidence that everyone, or at least not just bankers that have these incentive problems, but more broadly speaking, financial markets and maybe the public at large have sometimes expectations or perception of risks that are, let's say, not completely accurate.
I would like to pick up one of your previous points that you mentioned, and that's credit booms, because they can, from one side, stimulate economic growth, but also could be increasing the risk of experiencing financial crisis. So what differentiates between a good and a bad credit boom, and can bad booms be detectable?
Yes, they can. And bad booms are typically booms that go hand in hand with real estate price appreciation, with deteriorating external financial balances, so to say, worse current account position. And these are also booms that tend to be very sharp and very quick. So the size and speed also plays a role. We've shown in a recent paper that, yes, central banks can differentiate between good and bad booms with some accuracy in the data. This being said, we shouldn't fool ourselves and assume that we can always predict crises from now on. But I think we have made some significant progress in understanding what sets apart the good from the bad booms.
And with respect to managing these booms, how efficient are monetary policy and macroprudential policy? And more in general, what is their impact on credit cycles?
Macroprudential policy is sort of the new game in town. It is potentially very promising as a tool to manage excesses or risks in financial markets without using monetary policy, interest rates as a tool. The idea would be that using interest rates does harm, because financing costs rise. It affects the business cycle, it affects the economy, it affects employment more broadly, whereas macroprudential policies could be targeted towards the areas in financial markets, in lending, in credit markets, where there are perceived issues. The problem is that we don't know very much about how macroprudential policy actually works, what it does, how it interacts with the macroeconomy. We have shown in a recent paper that there are ways to estimate the effects of macroprudential policies on growth and inflation, and come away thinking that these effects are not very large and not very precisely estimated. So that's good news for central banks and other regulators to use these tools without hurting the economy in the way that, for example, using interest rates might do.
And speaking about the estimation, in this course you have engaged participants via practical sessions which focus on certain aspects of modeling, such as comparing early warning models or estimating the effects of monetary shocks and the microeconomy. Could you explain to our listeners what are the methodologies used and maybe highlight some of their aspects that they use for their own private activities?
Yes, of course. So what we do is in our practical sessions is first to estimate early warning models, just to get an idea like exactly how these models work and how we also compare the predictive qualities, the predictive abilities of early warning models. So we'll introduce participants to these tools, such as the receiver operating characteristic and obviously various types of pattern recognition, crisis prediction models. We will also ask how monetary and macroprudential policy affect financial markets and affect the macroeconomy more broadly through the tool set of so-called local projections, which are a method to estimate the dynamic sort of multiplier effects of policy actions directly from the data, and which allows for very flexible estimation also of state-dependent effects of such policies.
And finally, going back to the overall content of the course, if you had to select the main takeaways that you wish to highlight to course participants as well to the listeners of this podcast, what would that takeaways be?
The main takeaway is that the interactions between what's happening in financial markets, both in housing and equity market, but also in credit markets, and the real economy, the macroeconomy, are central and important to understanding general economic trends. There's been a lot of research in the past decade since the crisis trying to understand, both empirically and theoretically, the linkages that exist between financial markets and the real economy. And this course will bring people up to speed with these new insights. And I think if there's one particular element to highlight, it is that the puzzles and anomalies that people who do research in finance have highlighted for a long time, starting with Bob Shiller's 1981 paper about excess volatility, for which he got a Nobel Prize a couple of years ago, that these anomalies that we observe in financial markets are now slowly finding their way into how mainstream macroeconomists think about how the macroeconomy works. And I think this is an exciting area where, if you will, behavioral finance meets macroeconomics, where we can expect a lot of insights and sort of exciting new ideas going forward.
Well, thank you very much for your time.
You're welcome.